American Express, the credit card giant, recently announced its quarterly earnings. The numbers were good, really good. In fact, they were so impressive that they exceeded even the most optimistic forecasts from Wall Street analysts. This kind of performance is usually a cause for celebration among investors and market watchers alike. They beat what the experts predicted. Analysts had set high expectations, but American Express managed to surpass them, showcasing robust growth and strong consumer spending. Earnings were up, and people were spending big on their Amex cards. Sounds great, right? The company saw a significant increase in transaction volumes, indicating that consumer confidence was high and people were willing to spend more. Well, here's the kicker: the stock price went down. That's right, down. Despite the stellar earnings report, the market reacted negatively, sending the stock into a downward spiral. It left investors scratching their heads. How could such positive news lead to a drop in stock price? It seemed counterintuitive and baffled many. How could a company perform so well and still see its stock drop? The answer isn't straightforward and requires a deeper dive into market psychology and future expectations. The answer lies in the details. While the current earnings were impressive, investors are always looking ahead. They scrutinize every bit of information to gauge future performance. While the present looks rosy for American Express, the future seems a bit cloudy. There are concerns about rising interest rates, potential economic slowdowns, and increased competition in the credit card market. Investors are a forward-looking bunch. They don't just care about today's profits, they want to know what tomorrow holds. They analyze trends, economic indicators, and company strategies to make informed decisions. They don't just care about today's profits, they want to know what tomorrow holds. And right now, there are some uncertainties that are making them cautious. And right now, there are some storm clouds gathering on the horizon. These potential challenges are causing investors to be wary, leading to the surprising drop in American Express's stock price despite its strong current performance. Let's start with the good news. American Express has recently reported strong earnings, which have exceeded analysts' expectations. This is a significant milestone for the company, reflecting its robust performance in the current economic climate. The company's success can be attributed to a surge in consumer spending. People are using their Amex cards more than ever, especially for travel and entertainment. This trend is a clear indication of the pent-up demand that has been building up over the past couple of years. After being cooped up during the pandemic, folks are eager to get out and enjoy themselves. Whether it's dining at upscale restaurants, shopping for luxury items, or booking extravagant vacations, consumers are not holding back. Airports are bustling with travelers, and entertainment venues are seeing record attendance. This resurgence in activity is a welcome sight for many businesses that were hit hard during the pandemic. And they're willing to spend big to do it. This willingness to splurge is driving up transaction volumes for American Express, leading to higher revenues from transaction fees and interest income. This surge in spending is a positive sign for American Express. The company is benefiting from increased consumer confidence and a strong desire to make up for lost time. It means more transaction fees and interest income for the company. These additional revenues are crucial for American Express, as they help to offset any potential risks and uncertainties in the market. However, this spending spree might not last forever. There are several factors that could impact consumer behavior in the near future. Inflation is still a concern, and rising interest rates could put a damper on consumer spending. As the cost of living increases, people may become more cautious with their finances. If people start tightening their belts, American Express could feel the pinch. The company will need to navigate these challenges carefully to maintain its current momentum and continue delivering strong financial results. While American Express is enjoying strong performance right now, there are signs that its growth is slowing down. The rate at which its revenue and profits are increasing has started to decline. This isn't necessarily a bad thing, but it has made some investors nervous. They're worried that American Express's best days might be behind it. The company acknowledges that the economic environment is becoming more challenging. Competition in the credit card industry is fierce, and American Express faces pressure from other players like JP Chase and Bank of America. To attract and retain customers, American Express needs to offer attractive rewards and benefits, which can cut into its profits. Another factor weighing on American Express's stock price is its increased provision for credit losses. This is basically the company setting aside more money to cover potential defaults on its loans. In simpler terms, American Express is worried that more people might not be able to pay back their credit card bills. This concern is understandable. Inflation is putting a strain on household budgets, and rising interest rates are making it more expensive to carry debt. If the economy were to enter a recession, defaults on credit card debt could rise, hurting American Express's bottom line. Section 5. The price of progress. So, American Express is investing heavily in its business, particularly in areas like technology and marketing. These investments are essential for the company to remain competitive and attract new customers. However, they also come at a cost. American Express's operating expenses have been rising, which has eaten into its profits. While these investments are necessary for long-term growth, they can put pressure on short-term profits. Investors are sometimes impatient. They want to see immediate returns on their investments. When a company like American Express spends heavily, it can make some investors nervous, even if those investments are essential for the company's future success. Section 6. Analysts sound the alarm. Wall Street analysts, those number-crunching gurus who track companies and make predictions about their future performance, have expressed concerns about American Express. These analysts are often seen as the gatekeepers of financial wisdom, and their opinions can significantly influence investor behavior. When they raise red flags, it's a signal that something might be amiss. Recently, their focus has turned to American Express, a company long considered a stalwart in the financial services industry. While they acknowledge the company's strong earnings and spending growth, they are worried about the slowing growth trajectory, rising credit loss provisions, and increasing expenses. These concerns are not unfounded. The slowing growth trajectory suggests that the company might not be able to maintain its past performance levels. Rising credit loss provisions indicate that more customers are defaulting on their payments, which could hurt the company's bottom line. Increasing expenses, on the other hand, could squeeze profit margins, making it harder for the company to deliver strong financial results. Some analysts have lowered their price targets for American Express stock, suggesting they don't expect the price to rise as much as they previously thought. Lowered price targets are a clear indication that analysts are less optimistic about the company's future prospects. This adjustment in expectations can have a ripple effect, influencing not just current investors, but also potential ones who might be considering buying the stock. This negativity has contributed to the stock's decline. When analysts downgrade their ratings or lower their price targets, it often leads to a sell-off, as investors rush to offload their shares before the price drops further. This can create a self-fulfilling prophecy, where the stock price falls simply because people expect it to. Investors pay close attention to what analysts say, and when analysts turn sour on a company, it can spook investors and send the stock price down. The influence of analysts cannot be overstated. Their reports and recommendations are closely watched by both individual and institutional investors. When they express concerns, it can lead to a loss of confidence, causing a chain reaction that affects the stock price. In the case of American Express, the recent analyst warnings have certainly made waves in the market, leaving investors on edge. Section 7. What's next for American Express? So, what does the future hold for American Express? The company remains profitable and has a strong brand. People love their Amex cards, and the company continues to innovate and offer new products and services. However, challenges remain. The economic environment is uncertain and competition in the credit card industry is intense. American Express will need to navigate these challenges carefully to maintain its growth and profitability. It will need to continue to attract and retain affluent customers while managing its expenses and credit risks effectively. The company's success will depend on its ability to adapt to changing consumer behavior and economic conditions. Section 8. A lesson for investors. The story of American Express's recent earnings report offers a valuable lesson for investors. Don't just focus on the headlines. Dig deeper, look at the details, and try to understand the underlying trends driving a company's performance. Sometimes a company can report strong earnings and still face significant challenges. It's also important to remember that the stock market is forward-looking. Investors are always trying to anticipate what's going to happen next, and they often overreact to news, both good and bad. The recent decline in American Express's stock price doesn't necessarily mean the company is doomed. It simply reflects investors' concerns about the future. Section 9. Conclusion. American Express's recent earnings report presents a paradox-strong performance but a declining stock price. While the company enjoys robust spending by its card members, concerns about slowing growth, rising credit losses and higher expenses have made investors wary. The company's future success will depend on its ability to navigate a challenging economic environment and maintain its competitive edge. For investors, the story serves as a reminder to look beyond the headlines and consider the bigger picture when making investment decisions.